Okay, we'll get started. Well, good morning, everyone. This is JJ Richa with Pismo Ventures and the Venture Plan Competition. Good to have everyone here. As you know, competition is underway. Round one is done. Round two will start next week. On Tuesday, we'll have the business-to-business category pitching to investors. 5-minute pitch, 5-minute Q&A. So we sent out an email to everyone who made it from round one to round two. And also we sent out all the information to the investors and judges so they're able to log in and start evaluating the round two applicants or round two competitors. So we're in full force, all underway. We still have webinars like today and other webinars going on next week. I think Carrie is who's Phil's colleague, will be here in a couple of weeks as well. Again, don't miss the webinars, and of course, as you are all part of this, don't miss the attending the live judging events, because you will learn a lot from those. That's all I have. I'm gonna hand it to Phil so he can take it from here.
Yeah, thanks, JJ, and thanks to Pismo Ventures and your team for putting on the National Venture Plan Competition again. Buchalter has been a sponsor for the last couple of years, and happy to do it. So yeah, my name is Phil Schroeder. I'm with Buchalter. As JJ mentioned, we're a full-service law firm here on the West Coast. We have about 330 attorneys firm-wide, so we can handle pretty much any business issue you might have. We've probably got somebody to cover it for you. Personally, I'm a corporate attorney, corporate partner here. I work with a lot of emerging companies up to lower middle market companies, doing financing transactions and mergers and acquisitions. And should I share my screen now, JJ, and we can kind of jump in here?
You can get started whenever you want.
All right, so yeah, why don't we, we'll just jump in here.
You can ask questions along the way, and please put your questions in the Q&A section, and that way it's easier for Phil and I to be able to moderate the questions. Otherwise, you can still chat, but for questions, it'd be great if you put them in the Q&A. Thank you.
Perfect. Okay, JJ, can you see the screen okay? Is that looking good?
Yeah, screen is fine. Thanks.
Good. Okay. So good. Yeah. So, thanks to everybody for joining today. We're going to be talking about venture capital financings and the entrepreneur's guide to negotiating a VC financing. We're going to go through, a little bit of a background just on, venture financing in general, and if that's the right path for you. Then we're going to get into the deal terms that are most often negotiated in what I would call a full-blown venture capital financing round. This might be a little more complicated than your first round of financing. What we're going to be going through is kind of all the bells and whistles that you would see in a full venture capital round. Then more towards the end, we'll get into a little bit about what's market on some of those terms. And then finally, we'll talk a little bit towards the end about, seed financing or smaller round financings where you might have something less than, the full-blown venture capital terms that we're going to discuss here. And as JJ mentioned, yeah, you can put questions in the chat, and then we can try to address those as we go along, or maybe after we've gone through some of the some of the deal terms, we'll kind of circle back to some of the questions, but we can kind of play that by ear a little bit. All right, so then, the first really question here is, if you've set up a company, is angel or venture capital funding really the right way to go for you? It's not, that's not a given, and not every company lends itself to that model. So you want to think a little bit about what your exit strategy is, because the venture capital community, the angel investor community, they have very specific parameters for why they're investing. They're typically investing, especially if it's a VC, you're investing through a fund, which has a limited life. The fund takes money from investors, and the fund invests in the portfolio company, and the company you're setting up. And that fund wants to return the money to their investors within a set number of years. So that means that their investment in you as a portfolio company is really for a limited time, maybe 7, 8, 10 years. That's kind of what they're targeting. And then they want to sell the company, they want to get their money back. So if that's not your plan, if you're building this company because you want to work there for the next 20 years and then pass it down to your kids, that's a different business model and doesn't lend itself very well to the venture capital world, which is fine. It's a perfectly valid way to run a business. It's a great way to run a business, but it's just a different model. You also want to think about how much money do you need and when do you need it? Are you able to get an SBA loan or maybe a investment from friends and family that will get you to where you want to be in terms of building out your product and getting to revenue and sort of a self-sustaining company. And if that's that's what you need and that's what you want, and then you want to take it from there, then again, maybe you don't need the venture capital money versus a model where maybe you have a longer development cycle and you're going to be pre-revenue for a longer period of time, or pre-profitability for a longer period of time, and you may need money every 12 to 24 months. That's more of a venture capital model. So definitely those are the kind of things you want to think about off the bat if you're going to decide to go this route or not. So as I said, we're going to be talking about kind of a full-blown venture capital financing with all the bells and whistles. So what are the typical documents in that kind of a fully fleshed out round? Well, maybe somewhat obviously you're going to have a stock purchase agreement, which is going to define obviously the purchase price and the number of shares that the investor is buying. It's also going to have a lot of representations and warranties that the company is making about itself, so that the investors can feel secure and have some information about the company. There's going to be an amended and restated certificate of incorporation, and that's where you're going to define the rights and preferences of the preferred stock. There's going to be an investor's rights agreement typically, and in that, we'll get into this more later, but you're going to have that typically deals with registration rights, the rights that the investors may have to force the company to go public, or if it's already public, to have their shares registered so that they can be freely traded on a stock exchange. Then you'll have a voting agreement, which typically is going to address how or what directors need to be voted onto the board of directors. And then finally, you typically have a right of first refusal and co-sale agreement, which puts some transfer restrictions, usually on the founders' shares, maybe some other stockholders' shares as well. And again, we'll kind of go into the details of each one of these as we go forward here. So just a little more background, just to kind of make sure we're all somewhat on the same page here. What is preferred stock? Well, versus common stock. I mean, fundamentally, preferred stock is another class of stock that has certain rights and preferences that are superior to the common stock. The common stock is generally what's given out to the founders when you start the company, and maybe the first investors if you're having some very early round stage of investors. And then the preferred stock comes in and going to have some superior rights and preferences as stockholders. As you move on and you do multiple rounds of financing, as I said, maybe every 12 to 24 months, you do another round of financing. Typically, you'll create a new series of preferred stock each time you do one of those discrete rounds of financing. So you end up with a situation after several years where you've got, a series. Maybe you have a Series seed preferred stock, then you have maybe a Series A, a Series B, and a Series C preferred stock, depending on how many financing rounds you've gone through. And each time you do a series of preferred stock, the rights and preferences are going to be a little bit different. They may be very similar to the prior round, or they may have some, more significant changes. It kind of gets negotiated as you get to each one of those rounds. And again, the rights and preferences are of that preferred stock will be defined in the certificate of incorporation. Finally, just wanted to mention a little bit about, seed financing. The definition of seed financing is, it's a little, or angel financing is a little bit of a moving target, but I would say, and people have, different definitions for it, but I would just say, like, if you're doing a round that's, less than $1 million of money coming in, you're probably not going to go through all the deal terms we're going to talk about today, just because, as you could see from the the document list I had, it's 5 or so documents. It's kind of a lot of work, fair amount of work to get all that stuff put together, a fair amount of negotiation. If you're doing a smaller financing round, you might have kind of a stripped down version of what we're going to discuss today. Maybe you'd probably have some kind of a liquidation preference, and we'll get into these terms right after this here. But you probably have a liquidation preference. Maybe there's no dividend preference. Probably not registration rights. Probably not anti-dilution rights. Maybe there'll be some veto rights that the Series seed financing investors want. Probably typically no redemption rights, and then maybe a lot of things what you see in these early rounds is something called a most favored nations clause, which would basically say, like, okay, we're coming in this early round, we're not doing all the bells and whistles with all the fully negotiated deal terms. So, but we want the next round you do, if that next round of preferred stock is getting a bunch of additional preferences, then we in this early round, we want to get those same rights and preferences. So it's kind of kicking the can down the road a little bit by having this most favored nations clause, and allows those early investors to take advantage of the deal terms in a more fully fleshed out and negotiated financing round. Good. So that's kind of the background section. Now we'll kind of start getting into some of the deal terms and some of the things that get negotiated here. First is we'll talk about valuation, and this is less of a legal thing, but obviously perhaps the most important thing to negotiate in an entire financing when it comes down to economics. One thing that you should definitely keep in mind is this, and if you have one takeaway, this is one to think about, is these concepts of a pre-money valuation and a post-money valuation, and understanding what that means. The pre-money valuation is the value of the company prior to the investment round, and the post-money valuation is the valuation of the company immediately after the investment round. So let's say, for example, you have, you're going out there, you're doing your Series A round, or maybe your Series C round, and you've got, you're saying the company's worth $8 million. So you say, okay, $8 million pre-money, before you do, before any investment money dollars come in. So you take $8 million divided by the number of outstanding shares you have, and now you've got a per share purchase price. That's how you calculate your purchase price based on a pre-money valuation. And then let's say you bring in $2 million in this financing round. So you started with 8 million valuation. That was your pre-money valuation. Investors put in $2 million. So now you've got a company that was worth $8 million, and it's got an extra $2 million sitting in the bank. So now your company is basically worth $10 million. That's the post-money valuation. So, I see it all the time that, term sheets come in, and, there's been preliminary talks between the company and investors, and they talk about valuation, and, one side thinks it's a pre-money valuation, the other side thinks it's a post-money valuation, and there's a little bit of confusion, sort of right off the bat. So that's something to, when you start getting into those conversations, be mindful of those definitions, so you can avoid some confusion right off the bat. The other thing to think about in valuation is, obviously on the company side, you want a higher valuation, and on the investor side, you want a lower valuation. That's a sort of, the general the general trend for the two different sides. But both sides need to be mindful of what they're asking for. If you're on the company side and you're asking for a valuation that's too high and you actually get it, that can create some problems down the road. I mean, typically when you're doing this venture capital model, the idea is at each investment round, the valuation is going to go up. That makes everybody feels good, makes the prior investors feel good that their investments are growing, keeps everybody on a positive flow. But if you start with something that's overly ambitious and just too high, and you get in a situation where maybe you haven't reached all the targets you were hoping to reach, and then now you have to do what's called a down round, where the valuation actually goes down. Obviously your existing investors are not going to like that. Can create some issues if you have your investors have somebody who's on the board of directors. Can create some tension there, and it just creates problems. You might be triggering anti-dilution rights, which we'll talk about later. So just gets a lot more complicated if you're not having that sort of momentum of increasing your valuation, in each round. And on the flip side of that, if you're on the investor side and you're driving too hard to bargain and you're taking too much and at a valuation that's too low, when I say taking too much, I mean taking too large a percentage of the company. You may disincentivize your founders and your management team who you're, as you're an investor, you're investing in the management team as much as anything. And if you're taking too much and disincentivizing them, then, that's not healthy either. So really both sides need to, be mindful of what the other side is thinking. But ultimately valuation is what the investors are willing to pay. And it's a little bit more art than science with these early stage companies, especially because, traditional, metrics of valuing a company just are hard. They just don't fit the model of an early stage company. If it's pre-revenue or it's not yet profitable, it's making a loss. How do you figure that in a traditional model of valuation? So, in some sense, investors look at this and say, well, what's my exit plan? If I want to make a 10x return on this investment, they sort of reverse engineer the valuation. If I'm going to make a 10x return, how much money do I put in today? How much, what percentage of the company do I need to own? And then, knowing that where do I think this is going to be when we sell it in 7-8 years or whatever the time frame may be. And then you sort of, reverse engineer how much money you need to put in today and how much ownership interest you need today, knowing that you're going to do multiple rounds of financing and trying to anticipate what the company's going to be worth several years from now. That's a lot of how valuation works, frankly. But other things that are important to consider are market opportunity, the size of the markets you're going after, what sort of competition is out there, how quickly can you grow the business. Strength of the management team is extremely important. What kind of credentials do they have? Have they been through this venture capital type of company before? Have they succeeded? Have they failed? Failure isn't necessarily the worst thing in the world because you learn a lot from that. But what sort of track record do they have? What sort of vision do they have? What kind of drive? How motivated is the management team? Those are all very, very important things to investors. Obviously, the product and the solution that you're working on. Is it something that is it realistic, or are you trying to develop some technology that's, maybe just too far ahead of its time? How, timing in general, how is that? Is the market ready for this solution, or is this something that's maybe ahead of its time, a little too exotic? And, just the market may not be ready for it. Or on the flip side of that, are you behind the curve? Is there a bunch of competition already out there? Are you just tacking on to a business plan that is, already fully developed out there, where it might be hard for you to then, break into the market and compete with existing companies? So definitely those are important things. And then finally, progress to date is, of course, very important. If you can show that your development of your product is further along, obviously there's less risk for investment. Less money needs to go into R&D, and you can start putting money into, executing and sales and getting out to market. So, that's obviously very, very important as well. When you're negotiating valuation, obviously, maybe not obviously, but the best leverage is to have multiple sources of funding. If you can have multiple people chasing you, then you can create a little bit of a bidding war, a little bit of buzz out there. That's always extremely helpful. And then in terms of negotiating the merits of your company, well, you should go through the four things we just discussed there. Market opportunity, management team, your product solution, and the progress to date. Those are the things you really want to talk about. And then it's fine to ask the investor what their analysis is. If they're coming up with a valuation that's much different than what you think, then have a conversation with them. Find out what they're thinking. Maybe you can maybe the investors are misunderstanding what your market is, or misunderstanding what your product and solution is and how viable it is. You can perhaps address some of those issues with them. And then, lastly, it's worth thinking that, the valuation might be impacted by some of the deal terms, which we'll get into here, liquidation preference and dividend preference, that may also have a little bit of an impact on your valuation negotiations. Good. Okay. Well, now we're going to get into a little more of the legal stuff here. We're going to get into the specific deal terms that are in the venture capital financing. Make sure that you guys begin to understand some of the terminology, which is important when you're going through a term sheet. And also, like I said, towards the end, we'll talk a little bit more about what's markets. You can really understand that a little bit. So the first thing key thing that gets negotiated is the liquidation preference. Well, what is the liquidation preference? This is basically when you liquidate the company, whether it's being dissolved or being wound up, perhaps because it hasn't been a big success, or if the company has sold all of its assets in a successful exit. The liquidation preference sets out which investors get paid first. If the preferred stock has a liquidation preference, then they're going to get their money back first before the other stockholders are paid. And one thing to negotiate there is how much money do they get back first? Do they get just their investment amount, or do they get a 1x preference, that would be called? Or do they get some multiple of that? Is it 1.5 times their initial investment, or 2 times their investment? That's something that gets negotiated. And so how does this work in practice? Really, this liquidation preference is something that protects the investors primarily if the company does not do well. If you don't get to that exit, you have problems along the way, and you end up having to liquidate the company, kind of close down the company without really having a successful exit. If you do that and you have a situation where the investors are not able to fully get their money back, or maybe there's only a limited amount of money to spread around, the liquidation preference becomes really important, because the investors are going to get their money back first. So let's just give an example here. Let's say the investors are putting in $1 million. Let's say they have a 1.5x preference, so 1.5 times their investment amount. So their preference then is going to be, they invested $1 million, 1.5 times. Their liquidation preference is going to be 1.5 million. So let's say the company, God forbid, doesn't do well. and you have to liquidate it kind of in a fire sale. If there's only $1.2 million to go around in this fire sale, who's going to get that money? Well, the preferred stock investors are going to get all of that money. They're going to get everything up to the first 1.5 million. And the founders and the common stockholders get zero. So that's really, it's a little bit of a downside protection for the preferred stock investors. What are the different types of liquidation preferences that you see? There's basically fall into three buckets here. There's a non-participating preferred, a fully participating preferred, and a capped participating preferred. The non-participating preferred is, what that says is the investors are going to get their preference back, whether it's 1 times their investment, 1.5 times their investment, whatever the number might be. They'll get that money back and they get nothing else. So in our example, let's say, $1 million investment, 1.5x preference. So you get the preference is 1.5 million. Let's say you sell the company for 10 million. What are the preferred investors? They get 1.5 million, and the balance of the money goes to the common stockholders and the other investors. Well, in a non-participating, but what will happen in reality in that situation, though, is that the preferred stock investor would say, well, wait a minute, I'm only getting 1.5 million. If I held common stock, I would have got, I own 20% of the company, let's just say. If I owned common stock, I would have gotten 20% of the company. I would have gotten 2 million. So at that point, the investor takes a look at that and says, well, what's the higher value? Do I take my 1.5 million off the top, or do I forego the 1.5 million off the top and just participate with all the other common stockholders? And in that case, they would make the economic decision to participate with all the other common stockholders. So they would essentially not really have their 1.5 preference kind of doesn't really have much meaning in that context. That's the non-participating preferred. A fully participating preferred is let's take our same example again, and you're selling the company for $10 million. The preferred investors are going to get their 1.5 million back first off the top. Now there's 8.5 million left for all the other investors. In addition to that 1.5 million that the preferred stock got, they're also going to get, if they own 20% of the company, they're going to get 20% of the 8.5 million. That's the fully participating preferred. They get their preference back first, and they get to fully participate with the other investors. Finally, the last one is a bit of a middle ground there. It's a capped participating preferred. So in this case, investors get their 1.5 million off the top. Then they participate with the rest of the stockholders with the balance of the funds, but only up to a certain cap. Maybe it's 3 or 4 times their initial investment. And once they've gotten, if it's 3x, once they've gotten their $3 million back, they're done and they don't get any more money. The rest of the money goes to the other stockholders, the other common stockholders typically. And again, you have this decision point for the investor, right? What's the greater value? Do I take my capped participating preferred, or do I make the choice and say, well, no, just treat me like a common stockholder, and I'll just take my 20% because that's going to get me, more money. It becomes an economic decision as to what's the greater value there. That is so that is the different options on a liquidation preference. A dividend preference. So what's a dividend? A dividend is cash that the company pays. Well, I guess it could be other assets as well, but for this purpose, let's think of it as cash. A cash dividend, a cash payment to the stockholders that the company makes. Usually the company's had profits and they're going to pay a dividend. Now, frankly, there aren't a lot of dividends paid in venture capital backed companies. Usually, if there is extra money that comes in from revenue, that's usually plowed back into the company, trying to drive the growth of the company. So dividends are not typically paid in venture capital backed companies, but it can be important if you have something, we'll get to this in a minute, a cumulative dividend, which might get paid on a liquidation of the company. So if you are racking up these dividends, maybe you're not paying them year by year, but you're you've accrued this dividend, and which ultimately might get paid on a liquidation. So let's go through the three different options that you typically, three different typical options for a dividend preference. One would be no preference at all. The preferred stockholders, the preferred stock investors get paid. If there is going to be a dividend paid, they just participate just like any other common stockholder, like any other founder or other common stockholder. And we do that on something called, typically termed an as converted basis. We'll get into conversion a little bit more in a few minutes, but your preferred stock will have some conversion rate at which it converts into common stock. Usually right off the bat, that's almost always 1-for-1. So you trade in 1 share of preferred stock and you get 1 share of common stock. So when we say as converted, that's what we mean. We look at the preferred stock as if it was converted to common stock, and that's when you're figuring out what percentage ownership each stockholder has, that it's done on that as converted basis. The next option would be let's talk about cumulative dividend first, because I think that will make more sense. So a cumulative dividend is kind of like interest on a loan. So let's say you have an 8% cumulative dividend, and the company, as is typical, pays no dividends for the first several years. So it goes 5 years and it doesn't pay any dividends. But these preferred investors have this 8% cumulative dividend. So they're basically earning 8% on their investment every year. So when the company goes to pay a dividend after 5 years, it's not just paying 8% to 8% to those preferred stock investors. It's got to pay 8% over 5 years. So you've racked up a pretty big accrued dividend there. That accrued dividend also typically would get paid out on a liquidation when you sell the company. So when we were talking about liquidation preference, oftentimes it will say, one times your investment plus the accrued dividends. So if you have an annual, cumulative dividend that's been accruing for 5 years, you've got your 1x preference plus all these accrued dividends can start to add up after several years. In the middle ground here is a non-cumulative dividend. In that case, let's take that example again. You have an 8% non-cumulative dividend. You go 5 years, you've never paid a dividend. Now in the 5th year, you want to pay some dividends. You don't have to pay 5 years of dividends or interest. You only have to pay, for that year, basically 8% on the investment amount, not cumulated over 5 years, but just a straight 8%. That's the non-cumulative dividend. I don't know. I haven't been looking at the comments, JJ. I don't know if there's any comments in there or questions.
There's a question. The question is related to maybe with the numbers that you're giving, and it sounds very useful. They would be really much better if they're like on the screen or something, because I think they're getting confused with all the numbers. Yeah. So he's saying that that's Mohan saying it will be useful if numbers are used to explain non-participating preferred for liquidation examples. I think you did, but I think there were too many
numbers. Yeah, I can appreciate that. Yeah. I unfortunately, I probably should have had a slide with the assumptions here.
So let's see. Explain non-participating preferred for liquidation. So non-participating preferred. So that's I mean, you already talked about that. So basically, I guess Mohan, it's basically you get your whatever $1.5 million back, and that's it.
yeah, that's it. That's it. That's it. You don't Yeah, and the rest of the money goes to, let's call it the founders. If just to keep it really simple, if you have a really simple cap table with just founders and maybe an investment group.
So question on that, Phil. Usually with a non-participating preferred, usually in the agreement, there's an option to convert it into common stock because it makes more sense, right?
Yeah, absolutely. Yeah, absolutely right. So in a practical sense, that's exactly what happens. The investor looks at that and says, well, wait a minute, I could get more money if I forego the preference essentially and just participate with the common. So that's
if the company is growing and it's selling for $100 million, you'd want to do that because otherwise you get your money back, and that's not really what you signed up for as an investor.
Exactly right. Exactly right. Yeah.
Okay.
So that's in reality, that's what happens.
We have someone raising their hand. They want to jump in for a question over audio. Are you okay with that?
Yeah, that's fine. Yeah.
Okay. Andre, you're coming in.
Hey, Phil, thank you for the information. That's great. On the next slide, the dividend preference, you started out by mentioning how venture deals usually go, and I kind of missed that. You said they don't necessarily utilize these, or did you say that?
Yeah, So most venture capital companies do not pay dividends, and the reason for that is if there happens to be extra money, from revenue, usually that just gets pushed back into the company. The company doesn't want to release that money to the shareholders. They just want to drive it back into the company to drive growth, either more development or, more sales force or whatever they can to help grow the company. Because most of the venture capital investors, they're not really looking to get, annual payments. They don't really care about the short-term payments. They're only looking for a big exit. So that's why money just gets plowed back into, any extra money kind of gets plowed back into the company rather than giving it to the shareholders.
Thank you very much.
Yeah, that makes a lot of sense. So Mohan is asking the clarification, I guess. Again, he's saying, I meant the example of non-participating fully capped with numbers. Fully capped.
Okay.
Oh,
okay. So, all right. So maybe the capped participating preferred then. That's the one that's the most complicated, and frankly, the numbers, I probably fudged a little bit on the numbers there because that's the one that the math starts to get a little more complicated. Let me see if maybe I can give a better example. Let's say, and again, let's just keep this a really simple scenario where we have founders and you have, one preferred investor who puts in $1 million. And let's say their preference is 1.5x. So their preference is 1.5 million. And now let's say you're going to sell this company for $100 million. Just to put a nice big number on there. So the capped participating preferred says, okay, preferred investor, you're going to get your 1.5x preference back. You're going to get your $1.5 million taken off the top. The remaining money, the 98.5 million, then goes to the founders. It goes to the all of the founders and the preferred stock, because this is a capped participating preferred. So the founders plus the preferred stockholders get to participate pro rata based on their ownership interest in that 98.5 million that gets split up. But there's a cap on what the preferred investors are going to get. They're only, and that cap is maybe some kind of multiple, maybe 3x, 4x. So that says that the preferred investors, yes, you can participate along with the founders, but only up to a certain level. Only once you get, let's say, 4x of your return. So what that means is, so how does this shake out? So the first 1.5 million off the top goes to the preferred investors. Then everybody participates in the balance, but the investors, the preferred stock investors, only participate until they've made $4 million. Once they put $4 million in their pocket, the founders get the rest of the money. That's the capped participating preferred. But then, just as as JJ was mentioning before, with the non-participating preferred, there comes a point when you say, well, taking my preference doesn't make sense. Why don't I just treat this as if I'm converted to common stock? And if I own 20% of the company, then I get 20 million, just real simple. If I own 20% of the shares and $100 million, I'm going to get 20 million instead of capped at 4 million. So that's the capped participating preferred.
I think that's very clear. So for the fully participating, I think we should let you keep going. But for the fully participating preferred, they're actually double dipping, right?
They're double dipping. So they're getting their 1.5 million off the top, skimmed off the top, basically, and then they fully participate with the founders on the remaining 98.5 million. So there's no reason for them to forego their preference. The 1.5 million is kind of a freebie on the top, and then they participate in there. If they own 20% of the company, they get 20% of the the 98.5 million that remains.
And it's interesting what you said earlier makes a lot of sense, which is really the preferred is really when the company is not doing well. That's when it really makes a lot more sense.
So the reality is, and this is sort of in one of my later slides, but what this has come down to is people have kind of realized just what you said there, JJ. So the market term right now is a 1x preference and a non-participating preferred. It's very rare to see participating preferred these days. And it's just for that reason, JJ, that this is really downside protection for the investor. It's not really intended to kind of, juice their return if the company does well. It's really downside protection.
Right, but they're going to convert anyways, because it doesn't make sense not to convert if they're selling it for 100 million. So
right.
All right. There's another question from Jung. If there is a table with numbers explaining each. Okay. Oh, I guess maybe we can do that later. And if Phil has time, maybe he could create a slide with some numbers. But for now, I think we should let him go. Keep going.
Yeah, this is good. Next time I'll have to add that slide in there. So I appreciate the comments there. Okay, so let's talk a little bit about anti-dilution protection and provisions. What is anti-dilution? This basically protects the preferred stockholders in the event of a down round. And when I say a down round, I mean a situation where you're selling, investor comes in and let's say they buy shares at $1 a share. Very simple. If you do a future round financing and that share price goes down at something less than $1, obviously obviously anytime you're issuing more shares, there's some level of dilution to your ownership interest. But if you're issuing shares in a down round, then the purchase price is less. The new investors are buying a lot more shares, so the dilution is a lot more dramatic. And that's where the anti-dilution provisions kick in. If you're selling shares for a lower valuation than the preferred stockholders paid, that's when these rights kick in. We mentioned this a little bit before, and how this works is it adjusts the conversion price. We mentioned that the preferred stock has a conversion price into common, or a conversion ratio, I should say, into common. Typically, it starts out at 1-for-1, keeping it very simple. It's almost always 1-for-1 to start. Every share of preferred stock converts into a single share of common stock. Anti-dilution provisions change that ratio. And that's the protection that the preferred stockholders have. And that doesn't put money in the investor's pocket immediately, but it has other effects, because when we talk about what rights the preferred stock has, we mentioned this a lot. I've thrown this word out there before, on an as converted basis. So when that's where this conversion ratio becomes important. If you're talking about your liquidation preference and you're saying that the preferred is going to participate with the founders on a quote unquote as converted basis, if they're 1 for 1, that's one thing. But if you've had some anti-dilution and now you're 1 for 2, and so every share of preferred stock you hold is worth 2 shares of common stock, then that has more value on a liquidation. There's also the as converted concept is also used in voting rights. It might be used in registration rights and other things like rights of first refusal. So this concept of how many shares does the preferred stock convert into common can be very important in all sorts of other rights. And that's the benefit that the preferred stockholders get. That's their protection, their anti-dilution protection. So there's two types of adjustments. And I'm going to mention something called this full ratchet adjustment. And I'll say right off the bat that a full ratchet adjustment is never used. So if you see that in a term sheet, you can feel comfortable to tell your investor that they're crazy. But it's worth understanding at least what this is. A full ratchet adjustment says, maybe an example is the best way. And sorry, I should have put these examples in writing here, but I'll try to make it simple. Let's say you're a preferred stock investor. You bought your shares at $1 a share, and you convert at a rate to common stock of 1 to 1. If you do a subsequent round financing and you sell shares at 50 cents a share, then the conversion, the full ratchet adjustment would say, well, okay, you need to adjust my conversion price, fully for this, this new purchase price. So I paid $1. The new purchase price is 50 cents. So 1 divided by 50 cents is 2. So now my conversion ratio is going to be, 1 to 2, basically. For every share of preferred stock, I'm going to get 2 shares of common stock. It adjusts it just fully, full ratchet adjustment. But when you think about it, that might be a little bit unfair. Let's take an extreme example and say that, let's say the company only issued a single share at 50 cents. The preferred stock investor came in, they bought 10 million shares at $1 a share. And then a year later, the company decided, well, we need more money. We need 50 cents more money. So I'm going to sell 1 share at 50 cents. I know this is an extreme example that doesn't, is not reality, but it's just to make the point here. If you sold a single share at 50 cents, the full ratchet adjustment would say, well, that's a foot fault. We have to adjust the conversion price. So we're going from 1 to 1. We're going to, 2 to 1. Because you sold 1 share for 50 cents. But when you think about it, that's not really fair. How much dilution really is there from selling 1 share at 50 cents? Really, it's meaningless. And what the weighted average adjustment does, it takes that into account. It takes into account, the factors it takes into the account are, what is the purchase price in that second round, that down round? What is the lower purchase price? What is it? It looks at how many shares are outstanding before that down round where you issued shares at the lower purchase price, and it also looks at how many new shares are issued in this new round of financing that had the lower purchase price. Because again, using my example, if you issue a very small number of new shares, maybe that adjustment should not be as severe. That's what the weighted average adjustment goes. And these calculations are pretty complex, so it's kind of better. It's probably better to not try to put numbers on this and just sort of understand that conceptually, that those are the factors that are taken into account. So the real world reality is that full ratchet is never used. Everything is a weighted average adjustment. And there's kind of, broadly, there's two different types of weighted average adjustments. There's a broad-based weighted average, which is a little bit more company friendly, and a narrow-based weighted average, which is a little more investment friendly. What the difference is between these two things is it looks at, the question is, we said the three factors are, what's the purchase price in that subsequent round? How many shares are being issued in the subsequent round? You don't really have control over that. You don't know what that's going to be because those are events that happen in the future. And then the third factor that you do have some control is how many shares are outstanding. How many shares has the company already issued prior to that down round? And in the broad-based weighted average, it tries to say, well, let's include as many shares as we can to say that those are the outstanding shares. So obviously you're going to include all of the shares that the shareholders own that are physically outstanding and have been issued to people. That's kind of a no-brainer. But then you're also going to add in, let's add in all the shares from the option plan and all the that have been issued to option holders. Let's add all the shares that have been reserved for future option issuances. Maybe let's even add if you have any convertible notes out there, maybe let's even add, what those convertible notes, how many shares would those convertible notes add into? The idea is to make that number as big as possible so that if you issue more shares in the future at a lower price and you trigger anti-dilution, well, the new shares seem small in comparison to this large number of outstanding shares. So that's more company friendly because if you do have an adjustment, it's going to be a smaller adjustment on the weighted average analysis. Contrast that to the narrow-based weighted average, which is more investor friendly. Now you're going to seek to have that number of shares, outstanding shares, be as small as reasonably possible. So perhaps you're only going to limit that number to the number of shares that are actually held by stockholders. So you try to seek to exclude the option plans, seek to exclude the convertible securities. So you're just playing with that number as to what you deem to be the number of outstanding shares. That's the real negotiation point in terms of anti-dilution. I know that's kind of a complicated concept. So if we have any questions on that, we can circle back on that. Actually, I should keep moving here because we're kind of going a little bit slow here. Board of directors. Typically, when you have a preferred stock financing, full-blown financing, the preferred stock investors are going to want to be able to appoint one or more members to the board of directors. So kind of on this slide, kind of laid out a scenario. There's different ways that this can work. But in a typical scenario, maybe the preferred stock investors are going to have the right to appoint 2 people to the board of directors. Maybe the common holders can appoint 1 or 2 people to the board. Perhaps one of those people is going to be a founder. Perhaps one is going to be the CEO of the company. And then maybe you're going to have one other director who's an independent director, not associated with any investor or not working for the company. And maybe that person would be, selected by the remaining, all of the stockholders in general. But typically you're going to negotiate that, putting some people on the board of directors. You don't generally want to give complete control to the preferred stockholders. This scenario here where you have, say, 2 preferred stockholder directors, 2 common stockholder directors, and 1 independent director is kind of a good balance, perhaps, where you haven't really, you have that independent director who would sort of, there to kind of break ties, but if there's some dispute between the founder common stockholders and the preferred stockholders. Typically, the preferred stockholders, they might give that right to the lead investor in the preferred stock financing round. If you have a round where you have multiple investors, the one that's putting in the most money perhaps is the one that makes the decision about who gets to sit on the board for the preferred stockholders. And that right might exist with them for as long as they hold a certain number of shares or maybe a certain percentage of the preferred shares. That is something that might even be negotiated a little bit more between the investors to who's going to control those particular board seats. Also related to control of the company here are the veto rights and quote unquote protective provisions. What this is that the preferred stockholders are going to want some control over major decisions that the company makes, and they might want a veto right over certain actions. Basically, the company can't make certain decisions, take certain actions, unless they get approval from the preferred stockholders. And it's typically, some percentage of the shares held by the preferred stockholders. Maybe it's a simple majority. Maybe it's 60%, 70%. Actually, that number is often negotiated again between the preferred stockholders. If you have a lead investor who's putting in most of the money in that financing round, they may want to make sure that that percentage is set in such a way that they control that decision. So that is something that the investors will perhaps negotiate amongst themselves. The company has some input. They don't want that percentage to be too high, because they don't want, the lower the percentage, the easier it is to get the votes that you need to pass it ultimately. And the company doesn't want to be held up with these veto rights. So the company generally wants a lower percentage. But again, this is going to be driven oftentimes by the investors themselves and the relative control that they have amongst themselves. What are some of the actions that typically, the investors have veto rights over? Almost always is the first one here. If you're liquidating or dissolving the company, or having some kind of a liquidation event, which is basically a sale of the company, sale of assets, or a merger or a stock sale, that's going to be something that typically the preferred stockholders are going to want to have control over that, or a veto right over that. If you're making amendments to the certificate of incorporation or bylaws, oftentimes the investors are going to want a veto right over that. They want to approve that before they can do that, before the company can do that. If you're going to create or authorize the creation of a new series of preferred stock that has rights and preferences that are equal to or superior to the rights and preferences that the existing preferred stockholders have, that's something that typically requires approval. Also, increasing the number of authorized shares of the existing preferred stock. That's a subtle point. Oftentimes, when you finish a round of financing, you basically put a limit on the number of shares that the company can issue, so that they can't issue any more preferred stock without getting the approval of the preferred stockholders. So if you're going to increase that number of shares that they can issue, then that's something that the preferred stockholders want control over. Again, that would stop the company from issuing more preferred stock without their approval. Other actions, if you're redeeming any, or if the company wants to buy back any of their stock or issue a dividend, perhaps issue a dividend that is, in some other way than the agreed upon dividend preference, that typically requires approval. If you're going to, and this is a little less, you see this often, but maybe not always. If the company is going to issue any or take a loan, issue any debt security, or incur any indebtedness above some certain value, that might require approval. And then finally, if you're going to increase or decrease the size or the number of directors on the board of directors, that's typically something that might require approval from the preferred stockholders. Restrictions on founders' shares. Why do the investors want to put restrictions on the founders' shares? Well, one of the key things that investors are looking for is a solid management team. So they're, especially in the early stages, they're really, they're betting on the management team as much as they are the product or the vision. So they want to make sure that the founders and the management team are incentivized to continue to work for the company. The last thing they want is to invest a bunch of money in the company and then have the founders say, I'm tired of this, I'm going to go get another job. and then they just quit. So that would be obviously a bad scenario for the investors. So that's why they place some restrictions on here, both to incentivize the founders and to prevent them from cashing out, essentially. One way they do that is to add a vesting schedule to the founders' common stock. So, don't be offended if the investors ask this to happen. You may go into that prior to that round and you say, well, I own all the stock. I own it outright. Nobody can take it away from me. The investors may come in and say, well, we want to subject you to a vesting schedule. So yeah, I know you've owned your shares in the past, but we're going to say that, now we're going to attach a vesting schedule that says it's going to take, let's say, 3 or 4 years for you to be fully vested. And if you terminate your employment before you're fully vested, then the company is going to have the right to buy back your shares, the unvested portion of your shares, at some nominal price. Usually it's the price that the founder paid, which might have been a very small number when they started the company originally. So that basically ties the founder's hands to some extent because they want to be fully vested before they leave. That's one mechanism. And again, that is something that is not uncommon. So although some founders might, if they're not experienced, they might think that is, sort of an egregious thing, but it's really fairly common. Other restrictions are rights of first refusal and co-sale rights. These are restrictions on typically the founders' rights to sell their shares. A right of first refusal would say that, the founder goes out, finds a buyer for their shares, and the right of first refusal would say that typically the company and maybe the other preferred stockholders will have a right to say, well, look, instead of selling these shares to some third party, sell them to me. Either sell them back to the company or sell them to the preferred stockholders. It does a couple of things. One, it's definitely it's a deterrent for some new potential buyer because they might say, oh, shoot, you've got this right of first refusal. Why am I even going to waste my time? I'm never going to be able to buy these shares because you're just going to sell them back to the company or to your other investors. So it's a little bit of a deterrent effect to even finding investors who would buy the shares. And it also prevents these outside unknown parties from becoming significant shareholders in the company, so that the investors don't end up as partners with somebody that they don't really know. The other analog to that is the co-sale rights. If the company and the investors do allow you to sell shares to this third party, the co-sale rights would allow the preferred stock investors to sell alongside the founder. And they would typically do that, again, on this sort of as converted basis, based on your relative ownership interests. So let's say you're a founder, you want to sell 100 shares, but your preferred stock investors say, well, I want my co-sale right, and the preferred investors own 20% of the total shares. Then instead of selling 100 shares to this third party, the founder would sell 80 shares, 80%, and the preferred stock investors would get to sell 20 shares, 20% to this third party, which gives the investors sort of partial liquidity there. The idea is that, hey, founder, if you're going to get some liquidity and you think you might be bailing on this company, well, I want some liquidity too, so I'm going to sell along with you. That's how the co-sale right works. And again, it's a little bit of a deterrent to even trying to sell the shares in the first place. Registration rights, coming towards the end here in our deal terms. Registration rights are rights that, well, let me back up a little bit. So, shares in a privately held company like these venture capital-backed companies are difficult to sell. There's no market for them. You can't go to the New York Stock Exchange and try to sell your shares of this privately held company. In order to sell shares on a market like that, NASDAQ, New York Stock Exchange, you have to be a publicly traded company. being a publicly traded company comes with a lot of expense. You have to file periodic reports with the SEC, Securities and Exchange Commission. There's a lot of accounting that goes along with that. It's a very expensive process to be a publicly traded company. But the big benefit for the shareholders is that they have liquidity. It's very easy to sell their shares. So, that's when, a lot of goals of venture-backed companies is that they want to go public. That's sort of the ultimate exit, and typically the most lucrative exit for a lot of companies. But the interesting thing is here that when you say, hey, we're a publicly traded company, that doesn't mean that all stockholders can sell their shares on the open market. You could have a situation where you have a publicly traded company. Some of the shares are tradable on that stock exchange, and some are not. Some are still restricted. The registration rights give the investors the right to say a couple things. One, I'm going to force the company to go public. And two, if the company is going public, they need to register my shares so that my shares are the ones that get to be traded publicly, and I don't get left, holding the bag with a publicly traded company, but my shares are not. I still can't trade my shares. I still can't sell them. So that's what the registration rights are for. There's kind of three different types of registration rights. Demand rights are rights that the preferred stock investors have to force the company to undertake an initial public offering to go public, or to register their shares if they are already public. Typically there's limits on that. You can't force the company to go public immediately after you make investments. After you make your investment, you might have to wait a certain number of years. That only makes sense because, as I mentioned, going public is a very expensive prospect. It's not something for a very early stage company. So there are limits as to when you can demand those rights to go public and register shares. S3 registration rights are come into play when the company is already a publicly traded company, and you can do something called an S3 registration, which is essentially a short form registration, which is piggybacking on information on a larger registration statement that's already been filed with the SEC. So again, it's just another way to force the company to register your shares, and in this case, on this short form statement. And finally, there's piggyback registration rights, and that's a situation where the company is already registering other shareholders' shares or other shares, and the investors say, well, wait a minute, okay, you're already doing a registration statement, you're already registering some shares, I'm raising my hand, I want to piggyback on that registration, you need to include a bunch of my shares in this registration statement. Those are the piggyback registration rights. A couple other terms that I'll just throw in there real quick is maybe a right to participate in future financing rounds, which gives the investor the right but not the obligation to participate in future rounds of financing and allows them to maintain their percentage interest. A pay-to-play provision is actually not really a benefit to the investor. It's more of a company side term, company-friendly term. That is says that you, investor, you have an obligation to invest in a future round of financing. And if you don't, there's going to be some penalties. Whatever that the penalty can vary. Perhaps in the most severe case, the preferred stock is required to convert into common stock if they fail to participate in the future financing. Or maybe they'll lose some anti-dilution rights. Maybe they'll lose a board seat. Maybe they'll lose the right to participate in future financing rounds. But again, so that's a company-friendly term. And then lastly is redemption rights, which give the investors the right to force the company to repurchase their shares at some time in the future. And again, it gives the investor some liquidity. Usually you can't trigger that right for a few years, but it gives the investor a right to get out of the investment. Maybe selling the company to a third party is just not an option, but the investor wants to cash out. They can force the company to do it. That's a very investor-friendly term that you don't see very often because it can really put the company in a real bind. if they, if they don't have the cash to buy back the shares. So I've kind of gone through the deal terms here, and the last portion of this, I'm going to talk a little bit about what's market, and then a little bit about some smaller financing rounds that don't have all of these full-blown deal terms. So maybe now is a good time to stop. I don't know if there's any other questions, JJ. Any other questions in the chat or?
There is. Mohan is saying, what is the difference between a board of director and a board of advisors?
Oh yeah, okay, good question. So a board of directors has actual control over decision making for the company. The board of directors makes big picture decisions for the company, big directional decisions for the company. They also have to prove things like issuing stock, or making changes to the bylaws or the certificate of incorporation. Big picture decisions. Officers manage, sort of day-to-day activities and implement the direction of the board of directors. Now, board of advisors is an informal body that provides consulting and advice to the company, but they don't have any decision-making authority. The board of advisors has zero power to direct any decisions of the company. They're just there to give advice to the board and the officers.
Next question from Deepu. He's asking, is it reasonable to have supermajority requirements for board votes, say more than 67% of the board has to vote for something to pass?
Yeah, you do see that sometimes. You might see that sometimes. Yeah, for sure. There's some decisions that you might say, you need board approval plus the including the approval of this particular, director or something like that, or supermajority. So yes, you do see that sometimes with supermajority.
Yeah, that's it on Q&A. Nothing in the chat. So.
Okay, good. So let's go through a little bit about what's market out there. We talk, and I think I mentioned this a little bit before, liquidation preference. We had the different types of preferences. You had the non-participating preferred, the fully participating preferred, and then in the middle you had the capped participating preferred. You can see from this chart here, back in 2011, more than 40% of deals had a participating preferred. And look how this has come down all the way down to 2020. Only 10% of deals have a fully participating preferred. So it's much more common to have a non-participating preferred at this point in time. Along with that, almost no rounds deviate from the 1x standard liquidation preference. You can look at all these other, so this chart is everything other than 1%. 1% or everything other than 1x liquidation preference. And look at these numbers are virtually zero. 99+% of the deals are a 1x liquidation preference at this point. So you kind of know what the market is at that point. It's a 1x preference, non-participating. Dividend preferences also becoming more company friendly here. Cumulative dividends back in 2007 here, you had 30% of deals had a cumulative dividend. That's down to, actually I didn't have a number for 2021, but at least in 2020 that had come down to 16.6%. So again, becoming more and more company friendly on deal terms here. And what is a typical, if you have a dividend preference, what is a typical number? Well, the most common number is going to be between 6 and 9%, somewhere in there for a dividend preference. What you see on the chart is all the numbers other than 6 to 9%. So you maybe got something around 12. Yeah, and this number here, this highest number is the blue line here is 3 to 6%. So actually lower. So you got 6 to 9% plus 3 to 6% and 12%, and then the other number is very low. So you're talking, more than 80% of the deals are going to be between 6 to 9% typically. A couple other things that I mentioned, pay to play provisions, pretty uncommon, only appearing in about 4% of Silicon Valley deals. Redemption rights, also pretty uncommon, only in 4% of Silicon Valley deals. Here is a chart in general. This is sort of a very general chart, but PitchBook has come up with a way to evaluate the deal terms on a whether they're more company friendly versus more investor friendly. This chart, the 100 up here is sort of the most investor friendly deal. 0 is the most company friendly deal. So you can see here from 2016 to 2021, we're on sort of a downward trend, which means in general terms are becoming more company friendly, more founder friendly. And very specifically, just in the last last several months here, kind of even a steeper downturn towards becoming more company friendly, more founder friendly. And I think that was, JJ and I were chatting a little bit at the, before folks got on here, that there is a fair amount of money floating around out there looking for deals, and that's what's driving this to be more company friendly and more founder friendly, as more money tries to chase a smaller number of deals. Valuation trends. Well, the good news is 92% of financings in Silicon Valley in the second quarter were up rounds rather than down rounds. And by up rounds, I mean where this round of financing was at a purchase price that was higher than the prior round financing. That's always a good trend. If you're going down, that's kind of a problem. Median angel valuations for company valuations. That's this line here is the median number, is at 5 million, and that trend line has stayed relatively the same for the last few years here. That's 2018 to 2021. $5 million is typical company valuation for an angel round. For a seed round, this is the median line here. So you're looking at about 8 million, and that seems to be trending up a little bit here. The definitions between angel and seed are, they're a little bit fuzzy, quite frankly. And it kind of depends on who you're talking to. But this gives you a general idea of where things are. I'd also say these numbers here, these PitchBook numbers, are a national average. If you were looking at just Silicon Valley deals, these numbers would be higher. But these are national average numbers. Exits. This is something that is a big talk lately. The stock market is doing well, public markets are doing well, which is spurring people to, say going public is a very viable option for venture capital backed companies. There's also a very recent trend in the last couple of years with special purpose acquisition companies, SPACs. This is sort of an alternative method of becoming a public company, or sort of merging into a public company shell. But it's a form of transaction that has become very popular lately, and a lot of companies are becoming publicly traded companies via this other mechanism called SPACs. So all of this is resulting in greater exit values. So what we've got here, this trend line goes from 2011 to 2021. The bar here, the green bar here, is the aggregate dollar value of exits. And you can see these numbers are really pretty crazy, because these 2021 numbers are only 6 months through the year. I've only got data through June. So in 6 months, our exit value is already well above the annual exit value, or the full year exit value for 2020. 2019. Look, we're already above that. We're only 6 months through the year. As far as the number of deals, that's here, 883 deals so far this year. And that's only, again, through 6 months of the year. So if you double that, we're going to be at, 1,700 something exits, which is well above the prior peaks of less than 1,200. So your local corporate lawyer is probably very busy doing mergers and acquisition deals right now. There's a lot of activity in that space. Wrapping it up here, my last couple slides talk about smaller financing deals. If you don't want to do these fully negotiated rounds that have all of these full-blown documents, if you're doing maybe your first round of outside financing, convertible notes are a viable option. A convertible note is essentially a loan to the company that will convert into equity in the next preferred stock financing round. So you basically take the principal or maybe the interest as well, and you just buy shares in the preferred round financing that might happen a year or so after you put money into the convertible note. The real question there, and the only thing that it's a quick way of doing it, so you don't need to negotiate all the things we just talked about. Really, the only thing to negotiate in these convertible notes primarily is at what price is the convertible note going to convert? Is it going to be the same exact price as the preferred stock holders pay in that next round, or typically it's at some discount to that next round? The convertible note investors are going to get some benefit for being an early investor, essentially, and putting money in early. So that, a typical discount, most common one, is 20%. So they, when the convertible note goes to buy shares, they do it at a purchase price that's 20% less than all the other preferred stock investors are paying in that future round. Another type of benefit that you see is a cap on the conversion price. That becomes a little bit more predictable with the discount. You at least know what you're getting into. It's going to be it's a set percentage discount. With a cap, you can potentially have some unintended consequences. I'll give a little bit of an example there. Let's say you do a convertible note. You have a $10 million cap. And let's say then things go, exceedingly well, and you're doing a preferred round at $20 million. Well, now you've got preferred stock investors buying shares at a $20 million valuation, but your cap says that the convertible note investors are only going to pay half of that at a $10 million valuation. So you get a big disconnect there between what the, preferred investors are paying versus what the convertible note investors are paying. And that might cause problems for your preferred investors. They might say, well, wait a minute, why are these guys getting such a big discount? Maybe the company isn't worth as much as we think it is. And, they might start questioning their higher valuation once they see that. Another form is a SAFE, another form of early round financing, a simple agreement for future equity. If you're in California or Silicon Valley, you've no doubt heard of these. If you're outside of California, maybe you haven't, because they're less common in other areas. These agreements were something created by Y Combinator, which is an incubator in Silicon Valley. It's similar to a convertible note, except there's no interest rate and there's no maturity date. So it really never needs to be repaid, except, on some other events like liquidation of the company. So these are company-friendly documents. In 2018, just keep your eye on the ball. There was some changes to the valuation cap terms, which made it a little bit more company-friendly. They started using a sort of a modified post-valuation cap, where I guess we're running short on time, so I would just say be mindful of that and watch those terms if you're using the most recent terms on the valuation cap in a SAFE. They are more investor friendly. You're going to run into the cap sooner than you think, than if you had a quote unquote pre-money valuation cap. So just be mindful of that if you are using those SAFEs. Finally, very quickly here, for a Series seed financing, if you're doing an equity round rather than one of these SAFEs or convertible notes, you might want to look at seriesseed.com. They have form documents for a stripped down Series seed round. It's got a 1x liquidation preference, non-participating, no anti-dilution rights, some protective provisions. It's got a right to participate in future rounds. The investors get a board seat. It's got a most favored nations clause, and there are and it does restrict the founders' rights by putting some vesting conditions on the founders' stock. So those are some form documents that you can do for kind of a smaller round where you don't want to spend the time and money to negotiate all of the deal terms. So sorry, I've used up just about all our time. I don't know if there's any other questions there. You've got my phone number and my email address there on this last slide here. Please feel free to contact me right here. Oops, sorry, what did I do? There it is. So yeah, feel free to contact me if you have any questions.
All right, that's really great. So I have a quick question on the convertible note when you talked about the disconnect. So if there is a 10 million cap, let's say with a 20% discount, what does it convert? Does it convert really at 8? How does it convert?
Yeah, that's right. So if it's basically a 20% discount on the purchase price. So if your new investors are coming in at a $10 million valuation, and let's just say it's $1 a share, then your convertible note holders are only going to be paying 80 cents a share at basically an $8 million valuation.
Okay, so they do get a discount on the cap as well, or the valuation at that. Because
yeah, it's right. It's basically a different form of the cap is another kind of discount. Yeah, and typically if you have both a cap and a discount, the investor gets whatever's more favorable.
Whatever's less, yeah.
Yeah, whatever results in a lower purchase price.
Okay, all right. So there are a couple questions in the question box. Are VCs adverse to invest in LLCs or companies with only board of advisors?
Yeah, good question. I would say, VCs are traditionally more comfortable investing in corporations. The kind of the document set and the deal terms are traditionally all geared around corporations. It doesn't mean they won't invest in LLCs. It does create a little bit more of a problem. LLCs are passed from a tax perspective. There's something called a pass-through entity, which means that if the company has income, they're positive income, that income gets passed through to the investor. So which a venture capital firm doesn't want. They don't want to show income because then they have to pass through that income to their limited partners, the people who invested in the fund. So it kind of creates a little bit of a tax headache all the way up the line. So if a venture capital company firm is going to invest in an LLC, they might set up a corporation that's sort of what's called a blocker corporation so that they stop the pass-through taxes. So all that said is you can invest in LLCs. I think it's a little more complicated, and VCs are more used to and more comfortable investing in corporations.
Okay, question from Mohan. Do convertible notes have assigned value of company?
Yeah, it's a really good question. I mean, a lot of times when they have a cap as a shorthand way, if there is a cap as part of the note, a lot of companies will just assume that that's what that's what the value of the note is, and that's how many shares they will convert into. Whether that's really right or not, it's not really right, because you don't know if you're going to do a financing at that cap number. It might be less. So that's kind of a shorthand way. If you're trying to put them on the cap table and say how many shares is this note going to convert into, people often will use the cap because they just don't have any other number. Whether that's exactly right or not from an accounting perspective, I don't know. Probably not, but that's the best thing you can do.
One more question from Mohan. Can founders choose which safe to use, early 2013 or the 2018 version?
Yeah, you can. And I see a lot of the older versions still floating around. So yes, yeah, you can. It's up to you.
Well, it's up to the investor too, because they
Yeah.
may not want to do safes either.
They may not want to, right? Yeah, but I don't know. It's so popular right now. At least in California, it's very popular. It hasn't gained as much traction outside.
It is very popular, and we see a lot more of it. Pecos Angels in general, which is the group I belong to, in general, we don't do safes. I think we've done maybe a couple of exceptions, but it's just because it is so one-sided.
Yeah. It's funny. I'm not sure why they got so popular.
I don't get it. Yeah, but the other thing is on the safe is the fact that it does not really go on the balance sheet as debt either. So it's so friendly.
Yeah, and to be honest with you, and the hidden thing there is, I mean, anytime I talk to this about with one of my tax guys, they just pull their hair out because they don't, from a tax perspective, there's no clear line. Is it debt? Is it equity? How is it treated? It's a very, very complicated, it seems so simple from the investor and the company side, but when you actually try to do anything, I've had this situation come up recently where we've had a merger with company that had safes, and another deal I had where the company was they were an LLC and issued safes, which is a strange thing to begin with.
Wow.
And then now they're converting to a corporation, and we had all of these tax questions about what the heck do we do with these safes? How do we treat them? Is it a tax-free exchange? It was very, very complicated.
I mean,
there's no answer. Ultimately, there's no answer to it.
Yeah, I mean, although it's been around for a bit, but it's still not really battle tested yet.
That's right. Yeah, that's right.
We have John here who wants to ask a question live. I'll bring him in. So go ahead. John, you're on.
You're on mute.
Unmute. John, you there?
It looks like he's on mute.
Yeah, you need to unmute if you want to ask a question. All right. I'll request unmute. Let's see if I can do that. No, can't do that. Ask unmute. Here we go. Let me try it. All right, we'll let it go. Okay, well, thanks very much, Phil. I really appreciate this. This was actually, this was really good. I mean, we see different things like this, but you went into some details that I could tell you many of the entrepreneurs, with other presentations, people just go over them real fast. You went into some details where now they probably better understand preferred and the liquidation preference and non-participation and participation. So it's actually really good that you went into a lot of details. I think it's very helpful. We do have one more question, I guess. One more there is in the chat from Karen. She says, after deal terms are negotiated with the lead, do other investors joining ground automatically get same terms? Well, that's that's all negotiable.
Yeah, that's right. I mean, hopefully people will follow in line, but if one of the later investors is putting in a significant sum of money, sometimes that bends the deal a little bit.
Yeah, they're gonna ask if someone wants to have their own terms, they want to have their own terms. I've seen it many times. All right, Phil, thank you very much. That was really great again. Again, if you want to reach out to Phil, his email and phone number are right on the screen. This video will be available in the morning, by tomorrow morning on YouTube. So if you go to our YouTube channel, which is YouTube/Pismo Ventures, you can subscribe there, and then you can have access to the video and also to the slides. We'll have the slides in the description section. As a matter of fact, all the previous webinars we have, they're there, and the slides are in the description. There is a link, and then you click on that and you can download the slides. Thanks, Phil, again. We'll see you next week.
Yeah, my pleasure. Thanks for having me, and it's always appreciate the opportunity to speak.
All right, everyone else, if you made it to round 2, make sure you're ready with your 5-minute pitch and 5-minute Q&A. And that way, and also practice. Talk soon. Bye-bye.
Feel free to reach out with any questions.